And today we're going to talk about something that is all over the news and has been much anticipated, which is the Fed rate cut.
The first rate cut of a cycle is often seen by markets as the turning point of that.
If you stand with one foot in a bucket of boiling water and the other foot in a bucket of ice, on average, you're comfortable.
We often talk about the expectations of the market sort of already being priced into how the market is performing.
Hello, welcome back.
Hello, so good to see you for another week.
I know, here we are again. Great to see you too, as always, and great to be with all of you. Welcome back to Living Richly with Curo, episode number 72. We have another somewhat nerdy episode for you today, but there's just like a lot of nerdy stuff to talk about recently. So apologies in advance, but again, we'll try to make it entertaining and give you more fodder for your cocktail parties coming up. So if you are new to us, my name is Ann McCabe. I am the CEO and a partner here at Curo Private Wealth, and I'm joined, as always, by my lovely partner, Atricia.
Hello, I am Atricia Robert, the COO and partner here at Curo. Thanks for checking us out or coming back if you're an OG.
Yeah. OGs, we love you all. So if you are new here, we attempt each and every week in our podcast and also just in our day-to-day working at Curo, we want to inspire, empower, educate you on your financial journeys. And today we're going to talk about something that is all over the news and has been much anticipated, which is the Fed rate cut that is expected to happen today. So we're going to talk about what it may mean for the stock market moving forward, which everybody is interested in knowing, what has happened in past rate cut cycles, and what history can tell us. And very importantly, we're going to talk about what could be different this time, because while we are students of the markets and students of history, it is also important to remember that history does not necessarily repeat itself exactly the same way each and every time. So we are going to talk about some key differences in today's market and today's economy that we have to pay attention to. So I do want to note that we are recording this episode the morning of the Fed meeting. So we don't actually know at the time of recording what happened, but the market is pricing in a 96% probability of a 25 basis point cut, which is 0.25%, with an only 4% chance of a larger 50 basis point or 0.5% cut. So we are going to go off the assumption here that the Fed has decided to cut rates by 0.25%. Know that by the time you are viewing this or hearing this, the news is already in, but also just remember that as of the time of the recording, we don't exactly know what has happened quite yet. Full disclosure.
And making well-documented assumptions terrifies me a little bit, but here we are. We're going to go out.
Here we are
with it.
Yeah, exactly. So why don't we start off with what a rate cut cycle even means?
Of course. So the Fed raises rates typically to slow inflation or cool an overheating economy. So if you take a quick rewind back to about 2002, inflation was spiking up 9-ish%, and the Fed was raising rates, right? Trying to slow that overheating economy, the rapid rise of inflation. The first rate cut of a cycle is often seen by markets as the turning point of that, right? So we think of it as an easing. Before we were tightening, now we're thinking of it as an easing. But it is important to note whether the economy is strong or what we think of as a soft landing, or if it's weakening or a hard landing or already in recession. This usually matters a lot in how the markets will actually respond to the first cut of a cycle.
Yeah, absolutely. So let's talk about some historical experience here. We're going to share some key data points from past rate cut cycles. And we look to BMO Capital Markets for some good research that they have done recently on past cycles. And what they found is there have been 10 cutting cycles since 1982. And if you look 12 months out at average S&P 500 returns, the market, or the S&P, has gained 11% on average over those next 12 months. The S&P rose 8 out of the 10 times, so not 100% of the time, but 80% of the time, which is, pretty strong. And average returns are also positive if you look at shorter periods of time after the first rate cut. So 3 months, 6 months, 9 months, that sort of thing. If the economy avoids recession, which Atricia was just talking about, that soft landing scenario, the gains are even better with stronger returns 12 months out. But I think of a quote, and I thought it was attributed to Yogi Berra, but when I was looking it up for preparation for this podcast, it doesn't look like Yogi Berra actually said this. But I love this quote about averages, because anytime we're talking about average returns in the markets, or average economic data, I think it's important to remember how averages are calculated. So I love this quote about averages. If you stand with one foot in a bucket of boiling water and the other foot in a bucket of ice, on average, you're comfortable. So I thought that would be an appropriate quote to share here, just to remind us all that even though the average returns have been strong in past cutting cycles, that is not always the case. So if cycles where cuts begin, if they begin around recessions, or when a recession is already in place, those returns have been weaker than we just mentioned, and sometimes negative. So for example, in 2001 and 2007, when the Fed started reducing rates, the S&P 500 actually posted negative returns over the next year of negative 13.5 and negative 23.9% respectively. So keep that in mind.
Yeah. And we talk a lot to our clients about how we feel, or where we think we are in sort of a economic cycle. And I mean, we can never really know until we're already there whether or not it's we can call a recession. It's one of the things you don't know that it's happened until it's already happened to you. But we do see that things are slowing a little bit. So I'm curious to see how what we are assuming is going to be a rate cut plays out over the end of the year. Now, one of the things we also wanted to highlight is what could be different this time. So again, Anne has already reminded us that historical performance does not always tell us what's going to happen each and every time. So here's some things that could moderate the average returns going forward. One is that valuations are high. So it's a little bit of a geeky term, but we're thinking about the prices of stocks are pretty expensive right now if you think about how many multiples of their actual earnings. So that is something that could moderate returns this time around. Inflation is still a concern. While it, of course, is not as high as it was, let's call it 3 years ago, it is still in a place where I think it has not come down as quickly or as low as the Fed would have liked. So it's something that's still sort of on the radar. The labor market has been weakening of recent, so that, of course, could make things different this time. And a lot of the expected cuts seem to be priced in to market expectations already. So if you, and we talk about being students of the market, but we often talk about the expectations of the market sort of already being priced into how the market is performing. So we may not actually get as big of a bump, quote unquote, if we do see the rate cut happen today. And it's probably because we've already been expecting it for months. And then the global environment, supply chain challenges, tariffs, and geopolitical risks are all external factors that could make things different this time around in what we think is the start of a cutting cycle.
Yeah, I think one of the most challenging things right now is that we are in unprecedented times from a market and economic standpoint, right? I mean, none of us have ever gone through the global pandemic that we went through and the stimulus that followed. And yes, we've had high inflation in the economy and in the country before, but we've never really been exactly in the same situation that we're in now. And so it's hard to say, go back to 2001 or go back to the 80s. It's a very unique time, and that makes this sort of, understanding of what may happen that much more challenging. Not that we can ever really predict it perfectly, but we want to take this historical data with a grain of salt because we are in different times for sure.
Yeah, agreed.
Yeah. So here are our key takeaways. The first takeaway is if you do look at averages historically, the first Fed rate cut of a cycle has been followed by positive returns if the economy holds up. So remember, the key factor here is how does the economy continue down the path? Do we have that soft landing where we don't go into recession, or do we go into recession, or are we already in recession? Key distinction here. In recessions, cuts are often too little, too late. And so negative performance, it's possible. And it has occurred before in the past. So investors should temper their expectations because cutting rates alone is not magic. And we see this a lot in the stock market where, the market can get ahead of its skis a little bit and get really excited about the idea of interest rates being lower and possible stimulus in the economy, but it's definitely not magic. And interestingly, David Kelly, who we love and respect a lot over at JP Morgan, he's done some work on the economic benefits of higher rates because of consumer balance sheets and how much assets are on the balance sheets and how much interest investment has been generated. If you think about money market yields and high yield savings yields, that's income that is being generated for a lot of Americans. So while the lower interest rates are definitely warranted and wanted for things like mortgages and for spending, it actually may end up being a net negative to the economy because of the lack of interest income that may be generated. So I thought that was an interesting take and reminder. The good soft landing scenario is obviously what we are all hoping for, what markets are hoping for in particular, where inflation is in fact cooling. And even though growth is slowing, hopefully we don't see it collapse or fall off a cliff. And obviously employment holds up. We have seen some weakness recently in the employment data. We talked about how the BLS collects this data and calculates this data in our episode last week. But really, I think the key factor here will be how does the economy progress? And today in the press conference, it'll be interesting to hear Chairman Powell talk about that, right? And kind of key in on how is the Fed thinking the economy is doing and what sorts of things were they really focusing on and talking about before voting on this decision, right? Are they more focused on the labor market weakening? Or are they more focused on inflation being quite stubborn?
I'm curious to hear the comments. I mean, I think one of the things that has made the system sustainable for so many years is its independence, right? And the Fed being able to make decisions and make calls strictly based on what is happening or what they believe to be happening in the economic cycle and not necessarily from other, let's call them external pressures. So I'm always curious to hear, and I think the market is as well, to hear those actual comments in the press conference today, because those often are just as meaningful as the actual cut itself, right? To have an idea of where the Fed believes we're headed, and to your point, what areas of the economy they are most focused on or even most concerned about. So it will be interesting to see what we get today, and hopefully our assumptions about a cut today are correct. I don't know if the market could handle anything other than at least
No. Oh my gosh. Can you imagine? Yeah, that would be, we would probably pull this episode and completely
Yes.
re-record it
Yes.
because it would be such a surprise, not a good surprise to the markets
Right.
if there
To the
isn't
market.
at least a 25% basis
Yeah.
or
I
25
feel like we're
basis
going to
point
be
cut
right.
today.
I think we're going to be
Yeah.
right.
Yeah. I mean, typically historically when the market has this high of a probability priced in, it happens. And the Fed knows this too.
Yes.
So they
Yes, for
don't
sure.
generally like to surprise the markets in that way, cause havoc. So we'll
Yeah,
see.
that's what it
We'll
would
see,
be.
y'all. Yeah, exactly. All right. So time for our closing quote or our closing idea, thought of the day. So you always have great things despite the fact that you're like, I wasn't really sure what to talk about. And then you bust out these golden nuggets. So what do you have for us today?
I promise it's not a golden nugget today. It's really not. And it's actually probably more of just a catch up for me. But I am going to visit home, or what is home for me. I mean, it's weird calling it home because I've been here for so long, and this feels like home to me, but going to my birthplace home of Savannah, Georgia this weekend and going to see my grandmother who still lives there. And I was having a conversation and someone was like, "Oh, your grandmother's still living." And I'm like, yeah, she is. And I realized, I think, how much of an asset that is for me. So my closing thought is really just about family and cherishing family and the time you get to spend with them, because we know it's fleeting. So I am really excited to go home and see my family. I haven't been home since last Thanksgiving, I think. So it's been almost a year since the last time I've been in Savannah. So it'll be nice to just, it's like that feeling of Cheers, like where everybody knows your name, where I can move around with no map directions. I know exactly where things are, exactly where I'm going. So it'll be nice to have that sort of warmth of home, even for what will think be about 48 hours.
Yeah, it'll be
It's all I'm getting. It'll be a quick trip, but it's always good and sort of refreshing and always nice to go sometimes feel like a kid again, right?
Yeah.
Like I feel like I'm always making the decisions and always trying to be in control. And sometimes it just feels nice to go home and let someone treat you like a kid and let your grandma look for you and rub your head. So I'm very excited about that.
Get taken care of.
Yes.
Yes,
it's
that
nice
is lovely.
For about 48 hours.
Yeah, I know. The cooking will be amazing. The quotes, like your grandmother has some amazing sayings and quotes that we need to jot down in a book at some point.
Yeah.
So
I
can't
may
wait to
actually
hear.
start sharing them as my closing thoughts on
You
the podcast.
should.
I mean, the ones that are suitable.
Appropriate. Appropriate for our audience. Oh, we'll have an amazing time. I can't wait to hear about it. I'm
Thank
sure everybody
you.
will look forward to updates also.
Yeah, I'd be happy to share with you guys what's happening in Savannah, the big bustling town of Savannah, Georgia.
Yeah. Well, it'll be warmer than it's been here, that's for sure. So
yeah, but I love the weather here though, so I'm not necessarily excited about getting warmer, but it'll be nice.
Yeah.
All righty. So what's on your mind today? What do you have for our audience today?
I think I may have already shared this as a closing thought, but I don't care. I'm going to share it again because I have been repeating this phrase to myself multiple times a day over the past couple of weeks. So I think we've shared before that we are full blown in our fall busy client review meeting season. And so things are a little crazy. Just lots of meetings on the calendar, lots of preparation, lots of follow up. And from the F1 movie, where Brad Pitt's character says, slow is smooth and smooth is fast. I have been repeating that saying to myself over and over again because when I have 25 things I need to get done, my natural pace of 10 tendency is to rapidly try to get through them. And, then sometimes I'll be like rushing out of the door and I'll spill my coffee or, things happen when you're rushing. You also don't do your best work. And so I have to very intently remind myself that I need to slow down and that if I slow down, I will actually in the long run be quicker than if I speed through and don't do things properly. It's kind of like if you're late to a meeting and you're speeding and you get pulled over. It's like, well, now you're much later than you were going to be if you just drove maybe slightly over the speed limit, but not 20 miles over the speed limit. So I've been repeating that phrase to myself over and over again, and it's really helpful to me. So for any of you folks out there who have a high pace like I do, there you go.
Oh yeah, it's 10. I think you're probably the only person I know with a 10 pace.
She's not exaggerating. It's literally 10 per assessments that we do.
Per assessment certified that and have a pace of 10.
Yeah.
But no, I think that's great, because I think, and I was having this conversation with another one of our team members, and you want to, because I think we've also said before, you don't want like perfect to be the enemy of done, or
Yeah.
whatever quote is. But there's also, I think, a middle place to that, because you don't want to rush so quickly through it that you make the mistake and then just have to turn around and do it again to correct it. So just, I like that. Just a little bit of slowing down, just in the moment. You can still do a lot of things very quickly. That's fine.
Yeah.
But I think it is a good reminder to yourself sometimes.
Yeah, exactly. No, I will always have a lot of balls up in the air, but
Yeah.
I'm trying to more, methodically focus on what I'm doing and take a little bit more time than, rushing from thing to thing. So
yeah, good for you, because it's going to be it's already getting
it's already busy. Yeah, it's already busy, and it's just going to get busier through year end, and then beginning of the year for maybe a month it'll be a little bit slower, and then tax season will hit us. So
it comes in waves.
Yeah, exactly. So, all right, y'all. Well, thank you as always for joining us for another episode. We hope it was helpful. We'd love to hear from you. So please connect with us on Instagram, tag us if you had any big takeaways or if you have questions for us. You can also send in emails to podcast@curoprivatewealth.com. We love hearing from you. So keep the comments and questions coming, and we look forward to seeing you next week. And until then,
live richly.
Thanks again for tuning in. If you enjoyed today's episode, please be sure to subscribe and share it with someone who might benefit from it. Friendly reminder that this is for informational purposes only. For additional information, please visit us at www.curoprivatewealth.com. Until next time, live richly.